Okay, there we go. This is the first live Edge demo and discussion of 2025. Hard to believe. It's January 9th. I'm Tim Quast. With me is Brian Wilson. And thank you for being here. What I want to cover today, I've got four things. I want to talk about the daily mechanics because to me, that's the beginning point. What do you do every day? What we're trying to do is to minimize the amount of effort that you have to put into trading, investing. Short term, you can use these data for longer term waxing and waning your exposure to the equity market, but we want you to, it shouldn't take a lot of time. We want to follow high probabilities. We are not chasing the moon. We're trying very hard to take small, consistent gains because that's what the market gives. So I'll talk about that. I ran into an interesting restriction at Interactive Brokers that and I'll share it with you in discussions with them about. I'll use NVIDIA, which I did in the market desk note. Why you don't trade news. You get fooled.
What?
Don't do that. You want to trade market structure, not
Okay,
news.
sis, I'm in a meeting. We can sleep then.
Then number four, hey Brian, can you find that? You got it? Okay. And then number four, we'll talk about what's ahead and the characteristics. I've been writing about how there are characteristics that are observable that could mean that we are heading into a bear market. Now, I'm not saying we're going to. I'll share. It's pure math. It's got nothing to do with economics, politics, geopolitics, international relations. Nothing to do with that. It's purely math, and I'll share what we observe. So with that, let me get to, I'm going to share my screen, and I will talk here quickly about mechanics. Okay, there. All right, so here, this is my Edge dashboard, what I do every day. I'm going to always check broad market sentiment. This is the number one thing. This is what helps you know whether you should trade volatility or momentum. And when I say volatility, there's low volatility too. If you want to avoid a market that does these kinds of things and you're on the wrong side of the trade, you want to watch broad sentiment. How would one know that might happen here at December 18? And if you were here, in December, I said I had my largest ever volatility bet heading into this. And that turned out well. Doesn't mean it works out every time. I don't make money every time. I just make money most times. That's what I'm after, right? So, and those are dicier trades. I am not saying that you should go, wildly trade volatility. But notice this green part of the graph. When there is a lot of green, the market tends to rise. As the green decreases, markets tend to stop rising. It's not an absolute, it's just a central tendency. And because it's predictive, because it's telling us of things that are coming, can be very helpful. And when you know that demand is coming out of the market, the probability of reliable good returns and momentum begins to diminish too. So then you have to trade what happens when there's a change in direction of the market, which is volatility or its absence. And you could do that with low volatility. But notice this, the green part of the graph, that's, it's an algorithm. It's the core thing that we know. I just was meeting with our chief data scientist who does all the mechanics. And we were talking about some true ups that we're doing to the data and the core things that we understand about what you have to do with a trade, who executes it, why, how, where does it go? All those things are very important. They're far more significant than whether NVIDIA produces profits or not. Why? Because that's what the money does. NVIDIA is driven by flows, just like every other thing in the equity market, not by news or fundamentals per se. Those are contributors. They're inputs to demand, but they're not the only thing. There's much more money that is allocating resources to the equity market, where it sees the equity market as a product that offers a piece of a diversified portfolio, than there are dollars that are saying, I'm looking for a unique story. And the market is very much geared to serving the interests of investors who invest in products, and much less geared towards serving the interests of people who invest in stories, which is why stock pickers underperform. The rules of the market are inhospitable to that behavior. I don't like that. I don't think it's good, but it's what we've got. So demand, price of SPY and supply. So if demand begins to fall and supply rises, and then Jay Powell's going to speak and options are expiring, what is the probability of volatility? Well, it's fairly high, right? It's not an absolute, might not happen, but you put those things together, you're not betting, you're placing a high probability trade and hard to duplicate. But that's why this is the number one thing that you look at. Then mechanically, how do I know whether I will trade an individual security out of data? That's what I do. I mean, I've let the math do all the work. And when there aren't a lot of opportunities in momentum, it probably means that it's going to be harder to produce a return. But this is what I'm going to do. I prefer, it's not the only thing, particularly if the broad market sentiment is rising and supply is falling, there are a lot of components in the momentum portfolio. I like to place trades late in the day. I've talked about this. You don't have to do that. I think when it's booming, if there are 30 components in momentum, you can at the beginning of the day buy something and be prepared to guard yourself against half the volatility, because the market moves a lot. Prices move a lot. So if you're betting on, I wouldn't do this, but U.S. Steel, so it's got 5% volatility. That means you have to accept that the price could, wherever you bought it, could go down 2.5% or more, right? So if your stop is within that range and you get stopped out, it's because the tolerance isn't good enough. You have to be aware that this meters risk. This is what tells you what risk exists. But because you're stacking the deck in your favor over the next 1 to 5 days, producing some portion of it, 2% or more. That's all you're after. 2% is what the average stock in the S&P 500 moves every day between highest and lowest average prices. It's all over the market. A couple of days ago, I ran the data. It was 2.2%, the 5, 20, 50, and 200-day averages. So I'm saying 2 is a general rule. Well, that's your risk. That's how much the market moves every day. You've got to stomach that risk. But if you do, the probability that it rises and gives you the 2% or more that you're after is very high. In these cases, in the trailing data, 100% of the time. Past performance is no guarantee. And a core reason that I trade late in the day, I'll just use UVX as an example. This is a synthetic product. It is a dangerous thing to trade, but when you trade volatility, this can work. Notice this. This is, it's from Volatility Shares. It says its theoretical portfolio is priced, time-weighted average price, a TWAP, over the last 15 minutes of the regular equity trading session. Everybody who wants a reference price, so all those BlackRock funds, exchange-traded funds, index funds, all the Vanguard funds, all the Fidelity ETFs that are out there now, they're index funds. Invesco, I could go on and on and on. Everybody and all their brokers needs a reference price. What is the average as we close? That's why it matters, right? There's a very high probability that you will get a price that in the next 1 to 5 days will reflect the imbalance. So that's why we trade supply-demand imbalances. If I buy something like NVIDIA at 10 with declining supply at whatever price it is in the last 10, 15 minutes of the day, the probability is that in the next 1 to 5 days, all other things being equal, I'm going to make money on that, so long as I'm willing to tolerate a little bit of risk. That's what I do over and over and over. It doesn't work every time, but it's predicated on how the market works. Here's my comment too about something I found out. I trade these things at volatile periods. I trade the momentum portfolio when demand is rising in the market. I tend to trade low volatility when that isn't occurring, because it tends to be where all the money goes. And you can see that in the portfolio here. Low volatility has 4 times as many components as the momentum portfolio, because this is what all the money is after. I mean, it's crazy how you could go look at the ETFs that pick something, Apple, and go look at how many of them are volatility hedged S&P 500 instruments. They're trying to take volatility out. Okay, well, we'll use that to our advantage. Things become imbalanced into low volatility, which then outperforms the rest of the market during periods of volatility. So you could trade that. And then these are the mechanics. This is what I do. The stops and limits are always about the total volatility of the market, which averages in the S&P 500 2%. SPY over the entire data set moves 1%. That's why it's a big deal when those things break down. And I'll talk about that last. But I don't spend a lot of time thinking about this. And you'd say, well, what about the overnight risk? Well, yeah, there's risk, but that will tend to manifest in broad sentiment. It's if broad sentiment looks great, rising demand, falling supply, the probability that something that, because it reflects everything that's known. BlackRock has $20 trillion of assets using its Aladdin risk management system. It's got global macro inputs. It's got geopolitical inputs. Everybody's doing that. Millennium, Point72, all the big hedge funds, they've all got massive risk management capability. We will never, ever, ever have the resources to have what they have, but we can look at their effect, right? That's the advantage we have. We can look at all of those effects combined. So the probability that the overnight risk, if it's around options expirations, the Fed meetings, big data points like jobs tomorrow, those are risky events. And the least risky thing to do is sit out. The next least risky thing to do is to hedge long and short and trade volatility, which I did. I've got a small long, leverage long, small leverage short, and a small leverage ETF or volatility trade, because I don't know what's going to happen. But if something happens, my volatility bet will pay off. And I wouldn't do that unless the conditions warranted it. If supply was falling, I certainly wouldn't be doing that. Not sure I'd do anything, but I would say, but the long bet would be a far higher probability. And under these conditions, where supply has risen along with demand, creating this market that can't get its footing, what might happen? Well, I might get up and down movement in the market. Well, I can make money from that, right? That's all we're doing, saying what is the data telling us and what's the probability in a very short time frame. For the longer term, use waxing and waning demand. As you know, if demand peaks right around options expirations, all other things being equal, there was an election here. So this changed the outcome, changed the math, changed the behavior in the market, and it didn't behave exactly. It delayed the effect. That's all it did. Right? So, you know, the spreads between demand and supply will manifest. They can come early, they can come late. Rarely do they not come at all. Sometimes that's the case, though. But as a general rule, you could increase your exposure to equities when demand warrants it, when you see it in the data, in your long-term portfolios, like NVIDIA, and I'll talk about that here in just a moment, and then I'll hand it off to Brian. And then decrease it when you can see, wow, volatility is increasing, the supply is increasing. I don't want to have as much exposure to equities because it's unlikely to produce a return. You always want your assets producing a return for you. That's it's the aim. So NVIDIA. NVIDIA, by the way, maybe I should do this really quickly. Run a 1-year chart of the broad market and look at it. And just take a step back and say, lot of green, lot of green, lot of green, not a lot of drops below this green line. Then look at this. Right in here, it deteriorates. We start to see gaps. Here, no gaps. Here we had an entry point, nice, and then we're doing fine. Then we had this August event, and look at that. Now there are more gaps. We're not, there's a lot more space between the green and red lines. Well, that happens when demand begins to break down. This is the steepest drop since 2022. I'll talk about that last. So you look at this and say, well, that market is going to lose its momentum. And you can just look at it and tell. Let's look at NVIDIA and do a one-year view of NVIDIA. I mean, it's remarkable how in some ways similar they are. It's not perfect, but look at all this green. Boy, that's a great time. Here was not a great time. It just was flat. And so, if it drops below 5, maybe you get rid of NVIDIA and you come back when it goes back over 5. And so long as the graph is green, you own it. When it begins to deteriorate, which it did about the same time, NVIDIA is no better than it was in July. Right? It's not risen. You could trade that. You could trade it in here, more green, less supply. You could trade that. But look at it. It's very similar to the broad market. It has lost its momentum. It doesn't matter what news NVIDIA puts out. If the flows to NVIDIA have diminished, it's not going to rise. And what will happen is the machines will fool you. They'll run the price up and you'll think, oh, I'm missing out. And then boom, the price drops on you. That's what machines do. And they own the investment horizon of a day or less. We cannot outcompete them. better data, faster machines, can't do it. All you can do is look at it and go, well, that is not great. You can say I can tell long range, this is not great because this does not look like this. That's how you know. Last piece of the puzzle is this bear market view. And Brian, you can jump in on this. Let me back up. I think I'm going to do 5 years. So, it's a fairly limited data set because this data has not existed that long. And here, let's go to broad sentiment. It's not going to help us with NVIDIA. Let's go to broad sentiment. So if we look at the 5-year view here, right here, I just want to show you again the central tendency. I'm not getting bogged down in the data. I'm just saying, look at all the green. Here was the pandemic, massive amounts of money infused into consumers' pockets that flooded risk assets, and you had a lot of green, and then it broke down. It actually gave us quite a lead time to know, well, momentum's going to run out of steam. Notice the supply side, very high in this period of uncertainty, then way below trend all the way, that starts to rise. Once you have these big drops, see those? You start breaking below the green line. Entry point, yes. Short term, below the green line always produces a return. And it did this last time. When it broke below the green line, I bet long. SPXL, things like that, take quick profits because I don't know what's going to happen, but I know it's going to give me an move up. But these things mark the ends of bull markets and the beginnings, possibly, of bear markets. Happens every single time. The data set is not huge, but it includes some of the most dramatic events in the history of the modern market. So it gives us a pretty good data set. So you can know what's happening. So we come through this. Here's the 2022 bear market, and really, here's what happened. January 31st, 2022. Look how deep that dip in demand was, and look what happened on the supply side. There are monetary policy reasons, but you could look at that and say that's a change in regime. And we had a bear market, and it recovered when the last time it dropped way down. This was in October. We actually had a dip in December too, I think. But whatever the case is, notice this big dip, and supply peaked and then declined. End of the bear market. Then we were off to, and things were great. Lots of green, not as strong as this because it's a different kind of market, but a lot of green between the green and red lines. And then it deteriorated right in here. And so first hiccup was in May. Then we were fine, stayed lots of green, but then whoom. And look at the supply side. Steep decline on the supply side. Now it's rising. Now, I'm not saying this is the beginning of a bear market, but it has all the character. I could add more. There's one other little piece that I would share with you. And then Brian, I'll hand it off to you here. We have a lot of conversations internally. And let me see here. Here's one I just want to share with you. I don't often share data that is outside of Edge because I don't want you saying, well, we don't have access to that. This is data derived from SPY, and it's looking at SPY volatility. And it's all the way back to the very beginning of the data set, and there's something unique that happens every time that volatility in SPY. So that's the spread between the intraday high and low prices. Every time it spikes over 3% has been very material to the performance of SPY. It last happened in the bear market of 2022. In fact, if you wanted to go to the beginning, in late 2021, this happened. Maybe I can zoom that in. See this big spike, and then we had this huge spate of volatility all the way to the conclusion. Well, no, I'm not saying again, this is because something looks the same does not mean it will produce the same outcome. But we had a grand run of low volatility and wham, this and this are very similar. This was the beginning. And then it finished similarly, by the way. So is this the beginning? How long does it take? I don't know. I'm just saying I look at those conditions and I say, we're going to get more volatility because every time this happens, there is more volatility. It's not always this long. This was a long period of volatility on the way up, but it was because of the pandemic. It's a unique experience. But in any case, every time the market had trouble, it is punctuated by volatility. And the VIX will manifest it consequentially, but by then it may be too late. So you want something that's faster than that. And I'm just saying, could be. There are many things here that, without respect to all what might happen from a policy standpoint, could give one a sense that we may have a more difficult time ahead. And that's fine. We'll trade low volatility or trade volatility. It may mean that momentum gets harder to trade. So we'll see. All right, Brian, I'm going to stop there and hand it off to you.
Perfect. Thank you, Tim. Happy New Year to you all. If any of my friends are in California, just want to give you a shout out. My wife and I used to live in the Pasadena area, right there next to Altadena, all the fires there. In fact, we've had 3 friends that we know of so far that have lost their homes in that fire. So we know it's a big deal. Please know that our hearts and our thoughts are with you guys right now. It's very, very challenging. I wanted to start with actually part of what Tim just mentioned, and we'll move over to kind of that look ahead. So similar to Tim, I was looking at a five-year view as well. And I wanted to point out one thing here with that rise in short volume right in here. So very low short volume environment. It started to change right there in January. And specifically, this low was right around the 18th or 19th before it started to move higher. The options expiration cycle for that January was the 20th and 21st. So in other words, when we started to have a shift in short volume, which then stayed higher throughout that bear market, that shift occurred right at options expirations. We're coming up on options expirations. It'll start next Thursday and Friday. That's definitely something that that I'm going to be watching. There is what happens with short volumes. We've obviously seen a huge increase here, and let's give you a better look at that. It's about a 10% increase here over the course of the last month. Now, obviously, that was very, very low levels. So it's coming off of low levels. But right now, we're basically up to the 200-day moving average for short volumes. So it's becoming something that is certainly impacting the market. I mentioned it in the note this morning. As short volumes have started to increase, look at what's happened to the broad market. Now, sentiment was declining at the same time, but you have a combination of declining sentiment and increasing short volume. What happened to market gains? They went away. It's not a surprising outcome, and we've become very kind of lumpy, higher, lower. It's that type of environment when you're facing those types of conditions. We'll circle back here to a little bit of edge data in a moment. I did want to mention one thing in the daily trading ideas, and what I do every day, and these are the names that are in the momentum portfolio right now. I'll watch them every day. Similar to Tim, a lot of times towards the end of the day, I'll take 1 or 2 that I'll then buy. Urban is one that I had bought on Wednesday. And what I've been having a little bit of success with recently is after I make the purchase, I will then set my 2% limit, and and I think most of the brokerage houses have this. I'll use extended hours on that trade. So in other words, if someone wants to buy my Urban shares from me at 2% higher in extended hours, God bless them. I'm a seller, overnight, and that's worked out great, a couple of times. In fact, a couple of times I've sold overnight, and then perhaps those shares might even be lower during the regular trading hours. So it's perhaps just something to consider if you're regularly trading the daily trading ideas. When you set your 2% limit, just extend that to extended hours, and sometimes that will be of benefit to you. I did want to show you one thing that was happening recently in the energy sector. And let me go to the portfolios here. Not only can you trade daily trading ideas, a lot of times you can trade directionally. Tim has mentioned that either long or short. You can also look at sector trades, and I have a lot of different sector activity. But what I wanted to share with you was what was occurring towards the end of December. And before I get there, let me share one other thing. For each one of my sectors, I'll have something called the big companies, and it's 9 or 10 companies thereabouts. And the way I track this is I just grab the sectors and then I'll just sort it by market cap. So in other words, just find a cutoff level that looks comfortable to you. And, it's usually 10, 12 companies, something like that. And I'll just form a separate portfolio, based off of that. And the reason for that, sometimes it will give me a little bit of a head start with potential trading activity. And let me show you how this worked out with the energy sector in the latter part of December. So if we look at the 10 largest companies, and let's enlarge this, as we got towards the latter part of December, those 10 large companies got all the way down to 1.6 sentiment. So in other words, extremely oversold. Look at the rally that then came from oversold sentiment. Will that happen every time? No. Sometimes you'll get something where a sector might continue to languish. But as we came into this oversold sentiment, look at what also was happening. And this is the XLE, this is the spider for energy stocks. Look at when this started to bounce. So energy as a whole started to bounce on the 19th and the 20th. The 20th was triple witch expirations and S&P index rebalances. So in other words, a body in motion, in this case, the energy sector moved lower until we hit an inflection point, being the conclusion of that activity. And at the same time, we saw that all those big companies were extremely oversold. The potential was there, for a rally. It's part of the reason why I track it by some of the big companies. And look at that rally. For some of the energy companies that I track, especially in the small cap universe, that was like 15% in the course of a couple weeks. So, sometimes that would be a candidate where you buy it and perhaps hold it for a period of time. But I just wanted to show you how that can come into play, where you can track things by some of the big companies. And sometimes it gives you a little bit of an advance notice that, hey, maybe this is a potential for a trade. As we look at those big company portfolios, I don't know if anything will happen here or not, but I'll share with you what's happening in the financials right now. And I wonder if the financials are maybe getting ready to rally a little bit. So once again, 513 companies, big sector look. I have 13 companies in my big financials. Look at what's happening with those guys. We're getting some really significant short covering. Financials have been dead flat during the course of the last week. Could they start to catch a bid here? Certainly a possibility. It's one that I'm going to start to watch. Part of the reason that I'm watching it, these big companies are maybe giving me a glimpse that perhaps something better might be in store here over the coming few days. I mentioned the daily trading. Let's go to our big tech portfolio for a moment. As you know, we closely monitor this portfolio. And you can see, we had mentioned earlier that short volume was an issue for the broad market, and it's part of why we had this lumpiness. Look at what happened at the same time with big tech. So big tech peaked. This was about a week before expirations. Sentiment started to decline. Short volumes for big tech, relatively high. Those short volume levels tend to stay lower than the market as a whole, but they were relatively high, and the whole market was pretty lumpy, once again, with higher and lower movement over time. So big tech moving lower. Where do we go from here from a big tech perspective? We've started to stabilize just a little bit at 4.2, obviously just below neutral. Short volumes are starting to stabilize as well. That's going to be something that I want to monitor going into expirations week. I will mention one other item from a big tech perspective. This was a note that I read on just Yahoo Finance. A lot of times at the beginning of the day, I'll take a peek at what they have. Sometimes it's pretty good information. This was talking about big tech, and it was actually very similar to what we mentioned with you guys a lot of times. The theme here is that a lot of the big tech stocks really kept the market afloat during the course of the last month. And in fact, DataTrek co-founder Jessica Rabe, will give her credit for this. But she was looking at some of the big tech companies. They're seeing earnings revised up by an average of 5.1%. Meanwhile, if you look at the S&P 500, they're actually seeing those go the opposite direction. The implication here, I think we're going to continue to see this battle being played out in the market. Not only are we seeing it in the edge data, but we're seeing it from those that track it from an earnings perspective as well. So I think that's what I wanted to cover, Tim. Happy to address any questions if there's any.
Yes, please fire away. While you're formulating something to throw at us, please do. Our thoughts about what's ahead. And Brian, you've hit all these things. Options expire next week. It certainly looks to me like broad sentiment, barring some big move, peaks, and it might peak right about 5. That's not awesome. It to me is once again an indication of declining momentum in the market. Supply on a daily read has stopped rising. That could change too. I mean, if the market has trouble, that will continue rising. I don't know what's going to happen, but I look at the data and say, I don't see signals that tell me that we're going to have a booming period ahead. We'll see. We go through options expirations, come out the other side. They're turning points all the time. It's just incredible. I could show you how the S&P 500 components closed relative to midpoint from December 1 to December 18, and then from December 19 to the end of the year. They're like night and day. I mean, it's really incredible. What's the linchpin to that? As Brian said, it's options expirations, index rebalances. And it merely illustrates how essential to the way that the market works are passive baskets. It's the 70% of all institutional assets are functionally running on models. Doesn't mean they're going to all show up that way. Functionally, that's what they're doing. Because you and I are using target date, balanced, low volatility. I have these discussions all the time with my people who run managed accounts for me. That's what I'm doing, right? That's what we're all doing. And so it manifests in market behavior. And number 2, the use of derivatives. I mean, the fourth or fifth largest characteristic of equities is volatility hedged. Believe it or not, like passive large cap blend, single largest characteristic. Large cap growth, number 2. Large cap value, number 3. Maybe sectors, number 4, and it's a close battle. Number 5, volatility hedged. Just tells you how enormous derivatives are. And that's why options expirations next week are pretty important. So I just continue to say, from a trading standpoint, beware and hedge yourself. Be careful. You can do that very simply, as I do with like SPXL, SPXU. If I can convince IBKR that they're UBTI, what is it? What's that stand for? It's unrelated business tax. So I'm in a discussion with them about how they think that some of these synthetic ETFs are imputing futures income, and they're not. You have no ownership claim to any underlying asset with an ETF. It is a substitute. So I'm right. Well, we'll see how it comes around. But I use SPXL, SPXU all the time. If you're uncertain about the direction, then just hedge yourself a little bit. It's not difficult to do. You could trade a momentum or low volatility stock and have a little bit, just a little bit of SPXL and SPXU to hedge. If they net each other out and they're zero, who cares? And by the way, if they move, do the opposite of what you think you should do. Let's say that so you have an SPXU hedge and an SPXL long, and the market is rising, so your short position is deteriorating. Sell the long position. It's probably going to mean revert. So you make money, you realize the gain there, and then the market changes on you and your SPXU recovers. Then you can sell that. I mean, those things work great, but it comes back to understanding what is occurring in the stock market. 50% of the volume comes from machines with an investment horizon of a day or less that are profiting on how prices change, particularly ETFs versus the basket. So once you know what the supply-demand imbalance is, just like Brian pointed out with energy, what's developing in financials, you have a good probability of knowing which direction things are going to go. That's all I got. Brian, any wrap up?
Oh, that's it for me. Thanks, Tim.
All right, guys, we'll do it again next week.